Good morning. Thank you for joining us. My name is Simone Parker, and I'm with our Stakeholder Relations team here at CalPERS. It's our privilege to host today's webinar on our Asset Liability Management process. Before we get started, let me cover some housekeeping items. This webinar is being recorded and will be archived on our YouTube page in the coming week. A copy of the slides will be emailed to you following the webinar. We'll take questions following the panelist presentation. You can ask your questions by raising your virtual hand and we'll call on you. And then you can take yourself off mute. You can find this feature at the bottom of your screen under the reactions heart icon, or you can type your question in the Q&A box. We only have an hour together, so we'll try to answer as many questions as time permits. If you need closed captioning, you can click the show captioning icon at the bottom of your screen. So now let's get to today's agenda. We'll cover a quick overview of the asset liability management process. We'll explain the board's ALM decisions that happened in November. We'll cover actuarial assumption changes and impacts, and we'll look ahead. And as I said earlier, as time permits, we'll answer any questions that you have. So today I'm joined by our Chief Financial Officer, Michelle Nix, Chief Investment Officer, Stephen Gilmore, and Chief Actuary, Scott Tarando. This slide here highlights where we are in the ALM process. Today, we're doing this webinar following up the board's approval of the ALM recommendations that just happened 2 weeks ago. So here's our Chief Financial Officer, Michelle Nix, to briefly go over how ALM works and what the board adopted in the cycle for the PERP. Go ahead, Michelle.
Thank you, Simone. Good morning, everyone. Let's first start by defining what asset liability management is, or ALM as we like to call it. It can really be simply explained as aligning how we invest with what we owe in pension benefits. The ALM process runs on a 4-year cycle with a midpoint review after 2 years. Our ALM work is done for both the Public Employees Retirement Fund, or the PERF, and also what we refer to as our affiliate funds, which are the other trusts we manage and administer, such as the legislative and judges' pension systems, for example. So far this year, we've really focused on the PERF, which is the big fund that most people think about when they think about talk about CalPERS. The affiliate funds, however, their ALM, for that trust, those trusts are just getting started, and we're really working on it right now. And we will go to the board in the spring and summer of next year to talk about our recommendations following that work. Next slide, please. So the ALM, the purpose of the ALM is really how we continually work towards achieving our strategic goal of pension sustainability. The goal is to match what we think it'll take in investments to cover the liabilities. Truly, our focus is on sustaining the system and how to pay the benefits now and into the future. Next slide, please. Thank you. All right, so thinking back on how I explained the ALM a minute ago, aligning how we invest with what we owe in pension benefits, I want to talk about the investment office and what they do, which is a lot of analysis on the portfolio and the investment landscape, and what peers and other institutional investors are doing and thinking, and importantly, how much risk are we taking, and how much do we think we can actually earn from taking that risk. Meanwhile, the actuarial office is also looking at how much the pension liabilities are and how much they will be in the future. They're also considering how much we have in current assets on the books and how much additional funding we may need, because the PERF is currently not 100% funded. It's closer to 80 right now, so it's a little bit underfunded. Now, we also want to make sure that everyone is working together, and the board and the CEO have delegated the authority to the chief financial officer to oversee this work, which really kind of makes me, you can think of as a quarterback for the ALM process. Lastly, and most certainly not least, the Communications and Stakeholder Relations Division plays a huge role in this process. We make a big effort to roll the ALM into a lot of our stakeholder outreach, whether it's webinars like this or our newsletters, our website, and many more avenues. The board values your collective feedback on the ALM, and we make sure to provide plenty of opportunities to collect this information. The outputs of this work are what the board takes action on. So the outputs would be the discount rate and other actuarial assumptions, capital market assumptions, and past practice target asset allocations for our strategic asset allocation. This is changing, by the way, the strategic asset allocation process, and I'll explain that more momentarily. If you'll move to the next slide, please. So this was a very atypical ALM cycle. Stephen Gilmore, our CIO, brought new concepts, and we spent a considerable amount of time educating ourselves, the board, and everyone that's involved or interested in it at our stakeholders like you. So that was what we concentrated on a lot of the year. That's the way we designed our program to educate and inform. And really, it was a big lift. And it proved that but it did prove that our ALM approach was working as designed. So on slide 9, we'll talk about what the board actually adopted in November. So 2 weeks ago, the board adopted our ALM recommendations. We are transitioning from a strategic asset allocation investment governance model to a total portfolio approach model, which Stephen will cover in more detail momentarily. This total portfolio approach for us is establishing a new formal total fund risk, which will be made in 2 parts. We will use a reference portfolio to serve as our singular total fund benchmark and express the board's passive risk in risk market tolerance and capture passive market earnings. So the board approved this reference portfolio, and Stephen will talk about that in a minute, but it's basically a passive mix of what we would have invested in if we'd invested in only fixed income or equity and fixed income. And the board also adopted in November the active risk limit, providing the investment office with flexibility to make non-reference portfolio investments or things outside of that equity and fixed income parameter, which they set an initial limit of 400 basis points for the team to work within. And to talk even more about what this means, I will turn it over to Stephen Gilmore. Stephen?
Thanks very much, Michelle. It's probably helpful to think about just what changes and what doesn't change under our version of the total portfolio approach. At the very center, there aren't any changes to the board's authority. The board sets the investment risk, it sets the governance model. There's no change to the asset liability management process. We will still have this 4-year cycle with a 2-year check-in. So we'll look at the assumptions, expected returns, the actuarial analysis, and so on. So no changes to that. What has changed is that the board has adopted a somewhat different investment governance model where they've defined a total risk in terms of a reference portfolio that Michelle referred to. And that reference portfolio, as Michelle said, was 75% equities and 25% bonds. So that defines a market risk. The board has also then gone on to say, okay, management team, you can use some discretion around that reference portfolio. So you can have the ability to deviate from that reference portfolio to earn additional return. And they've done that via what is referred to as an active risk limit. And that active risk limit that the board has agreed was based on the amount of discretion that the team previously had. In fact, it's going to be slightly less than the team had before. but it's a consolidated into a single number. If you go to the next slide, you can always ask, why are we moving to a total portfolio approach? And I think the best thing, about it is it probably aligns the overall portfolio construction better with the ultimate objective. And of course, the ultimate objective is to ensure the system is sustainable. So rather than having lots and lots of benchmarks, we have people focusing on, okay, what's the overall portfolio? Is it achieving the objectives that we set? Now, it's not really a revolution, it's an evolution from what we had before. So we did have some flexibility, but now I think we will have a bit more flexibility and people will be more focused on the big picture outcome. One of the advantages is improved internal governance. In the past, the portfolio risk may have changed, and sometimes that may have been deliberate, sometimes it may have been unintentional. This time will be much clearer if the management team is deviating from the risk portfolio that the board has set. The reference portfolio itself is quite simple. It's clear. It can be thought of as an alternative portfolio. If we didn't have a big investment office and we only had a handful of people, that's really the portfolio that we would try to implement, a 75-25. So you can always judge whether the management team has actually done a good job or not. You can look at what the actual portfolio has done relative to this very simple off-the-shelf portfolio, which you as individuals could probably create through ETFs. It also introduces more simplicity. Right now, we have 11 different benchmarks for the various asset classes, and that becomes quite complex. With this move, there'll be one high-level benchmark that we're comparing our performance against, and that is a reference portfolio. That doesn't mean we won't be interested in, let's say, industry benchmarks or universe benchmarks for the various asset classes to form a view on how well the team's done. But at the biggest level, the high level, we'll be focusing on that reference portfolio. Have we done better than a simple off-the-shelf portfolio? That also leads to more transparency. It'll be clear how well we've done. And rather than, again, focusing on all those different asset classes relative to benchmarks, we'll be focusing on the big picture. That clarity, I think, will lead to greater accountability of management because all those deviations from the reference portfolio will be management's decisions. And we can then judge whether management has done a good job, and that makes, I think, management more accountable. And again, I was talking about the big picture, investing the portfolio in such a way that you're focusing on the ultimate objective. That means that all these decisions that we make will be taken with that in mind. So it's a decision for the whole portfolio. Putting all these things together, I expect that we will be able to generate somewhat higher returns because really we're focusing on optimizing the whole portfolio rather than optimizing various asset classes. And there is some evidence to show that this approach does lead to somewhat higher returns, although the sample sets are very small. But conceptually, it should lead to better performance. If you can go to the next slide. In terms of reporting, it's going to be very similar to what we currently get, what you get, what the board gets. There will be one addition. We are going to be revamping the dashboards, the risk metrics, but otherwise it's going to be pretty much the same. Every quarter, the board and you will see what our asset allocation is. You'll see the various risk metrics and so on. So just think not much of a change there. If you can go to the next slide. I just want to talk a little bit about the reference portfolio itself. And this is something that our consultants will propose, but the idea is that we have obviously equities and bonds. The equities will be a global equity portfolio, a cap-weighted equity portfolio. So very similar to what we currently have. The bonds will be a little bit different from what we currently have in our various benchmarks, and that will be a US Treasury benchmark over a range of maturities. So it's very simple, a very simple idea, and liquid. You can go to the next slide. I talked about the discretion that management will be able to use in deviating from the reference portfolio. And I've talked about, or Michelle mentioned the limit that we have, which is 400 basis points of active risk, i.e. deviation from the reference portfolio. We currently are operating at around 230 basis points of active risk. Now, a large part of that comes from private equity. And through time, we expect to gradually increase the amount of active risk we take. The limit, as we mentioned, is 400 basis points. We expect to be operating somewhere in the 250 to 350 basis point range. Now, in terms of the projections and the estimates we've come up with, we're expecting to generate active returns from taking that risk, and we're working on the basis of, on average, having around 300 basis points of active risk and generating around 60 basis points of extra return from taking that active risk. But of course, you'll be able to see that as we progress. Go to the next slide, please. One of the things we have done, one of the areas where we've done a lot of work in the last few years is on liquidity. And that's a potential huge advantage for us because we have a large, liquid portfolio. But of course, we need to be able to analyze just how much liquidity we have, because of course we always want to make sure that we've got liquidity on hand to pay all the pensions, that we've got liquidity on hand to meet our legal obligations. And we also want to ensure that we've got liquidity to take advantage of opportunities that may appear in the market. So conceptually, we think of what the portfolio may be, how liquid it is. We also look at what additional liquidity capacity we have. And we have a big margin of safety because ultimately we don't want to be in a situation where we are forced to sell things at the wrong time. So I think the work that we've done internally, the analysis is a strength for us. And I think we can use that more offensively in the sense of being able to take advantage of opportunities because of that work that we've done in the past. If you can go to the next slide. And of course, all these changes that we're talking about require a lot of internal work, and we set up a whole series of work streams to focus on various activities. The first work stream, of course, was getting this in front of the board, communicating, having this discussion over the course of about a year, and then hopefully having the board adopt the proposals, which they did, of course, in November. So that was the first work stream. A lot of effort went into that. And Michelle went through some of the, I think Simone mentioned some of the education sessions, board sessions we've had in the past. One of the other committees work streams is working on internal governance. And this continues to evolve, but I think we really have most of the entities that we need to be able to do this well. So we have internally committees that look at the total portfolio. We have an investment underwriting committee. This is really more about ensuring we have that collaboration and that visibility to make decisions on the whole portfolio. We will also be coming up with projected portfolios on an annual basis, and we'll be sharing that information with the board. But this is all part of the internal governance process. Portfolio construction, that's a big one. Because, of course, we're looking at what the optimal portfolio might be, given the various risk limits we have, given the opportunities we see in the market. Treasury management, that's core to what we do on liquidity. It's also really important in terms of thinking about rebalancing the portfolio to whatever targets we're applying. If you can go to the next slide. One of the things that the board will see in March is a redraft of some of the investment policies we have. Right now, those policies are quite lengthy, and often they are on asset class by asset class basis. But there's a lot of commonality in terms of what we're trying to achieve with those policies. So we're trying to synthesize some of the work and make it more fit for purpose for a total portfolio approach. Communication and engagement, obviously really important because this is a time of change. Change management requires a lot of communication, engagement, listening, getting ideas. That happens internally and also externally. Reporting, I've talked a little bit about that. You'll see that evolve, but essentially it's going to be very similar to what we currently get, plus some supplementary information. And on the implementation side, there's plenty for us to do. And you'll see us progress through the first half of next year. But this is really going to be a case of continual improvement. It's not an endpoint. It's a direction, and it's always about continual improvement. And with that, I'll pass over to Scott.
All right, thanks, Stephen. So another part of the process is the actuarial experience study. And what the actuarial office does for this part is we look at all our actuarial assumptions. And we look at both past experience as well as incorporating future expectations. And here's a kind of a breakdown between the assumptions that we look at. On the left-hand side, we have economic assumptions. We look at investment return, discount rate, and inflation. And on the right-hand side are just some of the demographic ones. I think these are the more impactful ones where we look at basically longevity, retirement rates, termination rates, and disability rates. And keep in mind that when we look at these are our long-term expectations over the next 20 years or so. And it's a blend of both expectations going forward and the past experience that we've observed in the system. Next slide. These assumptions impact pretty much all the results in the actual evaluation. I think some of the key ones that stakeholders are interested in, obviously funded status and contribution rates, both normal cost contribution rates as well as the PEPR member contribution rates. And it also impacts retirement options and service credit purchases as well, in terms of when we make those adjustments for the various retirement options or costing out service credit purchases, our assumptions do impact those costs. Next slide. So in terms of the demographic assumptions, we'll start out with looking at the retirement rates and the mortality rates. And what the board adopted was some minor adjustments in these rates. For mortality, there was just a slight reduction in the projected mortality rates going forward, but there was really not that much of an adjustment in both either mortality rates or the retirement rates. There were some adjustments and some consolidation for the disability rates to be a little bit more consistent across the various groups, but for the most part, the impact on these changes in terms of contribution rates were fairly slight. Next slide. Some other demographic assumptions we looked at were termination with refunds, salary scales, and things like the percent married and spousal age difference. The one big impact, I would say, or the biggest change out of this group was the salary scale. Our observations in terms of the last several years have been there have been consistent salary losses for a number of the systems and plans. And so we had to make some adjustments. And basically, we had some increases for the merit for the majority of the plans. For the schools and for the state industrial, there was actually a slight decrease. But for the majority of the public agencies, we had an increase in terms of merit and longevity for the salary scale, and that would translate to slightly increased contributions. Next slide. In terms of economic assumptions, in terms of the discount rate, that remains the same. It stays at 6.8. Both price inflation and wage inflation, we had a modest increase from 2.3% to 2.5% for price inflation, and a similar increase on the wage inflation, basically increasing it 0.2%. Inflation has been consistently higher, obviously over the 2.3%, and remains, it was definitely well over 3% for the last 4 years, and continues to be much higher than 2.5 even currently. Inflation has come down. It was well over 3%, and it's come down to slightly below 3%, but it's still elevated to where we had the assumption set, and we felt we needed to bring up our current assumptions. at least a 2.5%. Next slide. In terms of impact on contribution rates, what we have here is we have projected impacts on contribution rates based on your current benefit formula. And what we have is we have the a minimum impact, a maximum impact, and the median impact. So for example, if you're sitting at the classic 2.2% at 60 miscellaneous formula, we anticipate the minimum impact to be about the 0.1%, with the maximum going up to 0.9%, with the median of a 0.3%. And a quick reminder on when we say median, we mean half the plans are below that number and half the plans are above that number. And you can see the ranges are fairly not too large for the miscellaneous plans, with the median being well below 1%. For the safety plans, the increases are larger, a little bit larger, except for the 2 at 50, the 3 at 55, and the 3 at 50 plan. Most plans are half the plans are going to see around a 2% increase in contribution requirements. The 2 at 50, which is the most better, one of the more beneficial programs out there. The costs are going to be closer to 3%. We also have the Pepper formulas in terms of the range and the impact at the bottom of this chart. Next slide. We also looked at the impact on state and schools. You can see this. We have the normal cost change, the unfunded liability, and total change for the various state plans. For the schools pool, it's at the very bottom. We see a normal cost change of around 0.5%, a slight UAL increase, and total impact to cost of around 0.6%. Next slide. In terms of funded status, what we have here is we have the impact on both the 24 and the projected 2025 funded status. And there's a slight decrease in the funded status. As you can see, for 24, the decrease was 0.3%. And for 2025, we expect it to be a little bit higher of a 0.4%. So a slight decrease in terms of funded status for the overall system of the PERF. Next slide. In terms of Pepper member contribution rates, what we have is we've broken it down by miscellaneous plans and safety plans. And you can see in terms of looking at the miscellaneous plans, the majority of the plans we don't see being affected. You can see that the percentage was very small for the miscellaneous plans. We have just 9 plans out of over 1,400 plans being impacted by the change in assumptions. And you can see the corresponding number counts as well. Definitely less than 2% of the members for the miscellaneous members would be affected by the assumption change. Going over the safety plan, unfortunately, there's a bit much more dramatic impact, and you can see probably around 2/3 of the plans and around 2/3 of the members will see some kind of impact in terms of required Pepper member contributions. Next slide. In terms of when all these changes occur, we will be implementing these assumptions for these June 30, 2025 actual evaluations, and those come out in the summer of 2026. In terms of when to impact the contributions, public agencies will be impacted in the 27-28 fiscal year. State and school contributions are a year earlier in the 26-27 fiscal year. Also, all retirements on or after November 20th. All the option factors will be based on the new assumptions, and service purchase credit calculations will also be based on the new limits and assumptions. Next slide. I will pass it back to Simone.
Great. Thanks, Scott. So, as we mentioned earlier, next in the cycle will be the review of the affiliate funds ALM, going to the investment committee in March and June. Investment policy updates reflecting the board's adoption of the total portfolio approach will go to the board in March as a first reading, and the board will vote on the proposed changes in June. Before we open it up for Q&A, here are some resources and information on who to contact if you need additional details on the ALM cycle following this webinar. So with that said, that brings us now to our Q&A portion of the presentation. As I mentioned earlier, you can raise your virtual hand if you would like to ask a question live. It does look like we have a couple questions in the Q&A. So I'll start with the one that probably Scott would be able to answer. It looks like JJ is asking, GASB says the discount rate is the long-term expected returns. If the expectation is for higher returns, why not raise the discount rate and therefore cut employer contributions?
A couple of things on that. First of all, the GASB discount rate is not the same thing as the actuarial valuation discount rate. They're defined differently. And if you go through, you look at how GASB defines it, they don't take admin expenses into account. So the discount rates have always been different. If you look at GASB 68, the GASB 68 discount rate is 6.9%, and it's been 6.9% for the last several years. So there's always been a difference in these two rates. So then just looking at the discount rate for funding, we look at a number of items. We just don't look at what the expected return is or CMAs. I mean, CMAs are very volatile. So we look at, in terms of, not only do we look at CMAs, but we look at expectations in terms of risk analysis, and we look at where the funds are going. We look at the probability of getting certain discount rates. If you look at some of the presentation slides in November, we discussed the probability of getting a 6.8% and the probability of getting a 6.9%. And our analysis showed that the funded status would actually be lower and contributions would be higher with the 6.9% versus the 6.8% with the number of the portfolios that we looked at. So it's not a simple prescriptive, take the discount rate or the expected return, and that's what the discount rate is. There's a lot of analysis that goes into it, and it's not a simple formula that sets discount rate used for valuations.
Thanks, Scott. It looks like JJ had another question in the chat. I think this was for you, Stephen. It says, if only one benchmark, how do you tell if the asset management groups, say equity and fixed income, are doing well?
Thanks for the question, JJ. As I mentioned, at a high level, there is a primary benchmark, which is how did the overall portfolio do against the reference portfolio? But of course, we do want to assess how each of the individual teams has done with respect to the implementation of the investment strategy that they are pursuing. So our plan is to have a whole series of internal benchmarks for each of the investment strategies. So that will allow us to work out or to assess how well the team has implemented those strategies. So those strategies or strategy benchmarks should be representative of the strategy. So we'll have both. And having both means, first, we can assess whether we've done a good job of allocating capital to the right strategies. And then second, have we done a good job of implementing those strategies? But of course, the main thing is, well, have we done better than the reference portfolio? Have we done better than that simple off-the-shelf alternative to the more complex portfolio that we have?
Thank you for that. Scott, how can agencies forecast the fiscal impact of the actuarial changes?
Probably the best way to impact the changes for your particular agency is you can go to Pension Outlook, and there you can pull up your own agency and do projections and look at various projections, not only by changing the discount rate, the expected return, but there's a toggle now where you can use the current assumptions used in the 24 valuation, or you can toggle it to the 25, the new assumptions that were just adopted, and see the impact of those assumptions. So you can actually just go out to Pension Outlook and toggle back and forth between the two assumptions and see the potential impact for your plan directly. And this applies, for all the public agencies out there.
Thank you, Scott. And I believe your team is in the process of updating those assumptions. The tool should be updated today or in the next couple days. But
Yeah. I think it goes live with new assumptions or the ability to incorporate new assumptions either today or tomorrow. So it will be out. If it's not available today, it should be available very soon. And then we plan on sending a circular letter out telling everyone that Pension Outlook has been updated to the new assumptions as well.
great, thank you. I'll go ahead and take a question live. So Aaron Robinson, if you want to come off mute, you can go ahead and ask your question. You should be able to click the little microphone to unmute yourself. There you go.
Hi, I'm so sorry. I didn't realize my hand was up. I didn't have a question. I did that by
Oh,
accident.
okay. All right, wonderful. Thank you. JJ, you have your hand up. Did you have any additional questions?
Yeah, this is actually a follow-up. Scott, if the expected higher return would normally lead to a higher discount rate, what are the factors that are holding the discount rate down so that we're not changing it to reflect the higher expectations? Is the question clear?
No, because I mean, when you look at I'm not sure what you're talking about, JJ, because
In the absence of anything else, the higher return would lead to a higher discount rate. But there are other factors, and what I'm trying to get to is what are the factors that are holding the discount rate down?
we just we look at a number of things, and you got to remember, JJ, you're talking about a return. Where is that return coming from? First of all, it's based on a survey. And if you look, those numbers aren't very, I hate to say the word robust, but I think you understand where I'm saying, where you can't, there's a large range of credibility around those numbers. So you can't just pick out the return and say, this is the return, and this is where we're, and be 100% certain that that's where we're going to end up. So there's a range based on, your portfolio, for example. I mean, I'll give you an example. You have an expectation on equities, and you have, a standard deviation or in terms of the mean and the returns of where 95% of those returns are going to be. Compare that to a portfolio of treasury bonds. How much of a variation are you going to have? So obviously, the makeup of your portfolio is going to dictate, the confidence you have in those assumptions. Stevens talked about before, there's a wide range of results. The CMAs are based on surveys. Those surveys change every month. So, keep in mind numbers. If you're looking at a survey that was done 6 months, 8 months ago, the economic conditions change. So what we need to do is we need to find a discount rate that's fairly consistent, fairly conservative. Because remember, we're funding the pension plans, and the goal is to fund the pension plans to 100%. And currently, we're underfunded. So you want to ask yourself, why are you taking risks in underfunding pension plans when there's a lot of variables in the calculation? And so those are just some of the items that we take a look at.
Okay, I'm not trying to put words in your mouth, but what I'm hearing is a relatively low confidence level in the expected return that was used in generating that.
I wouldn't say low return confidence. I would say it's no lower than it's ever been. I mean, when you take CMAs, what are you getting? You're getting you're getting a list of expectations. It's no different than the government expectations on inflation. You know it's not going to be that. It's going to be somewhere around that. There's going to be variability. There's going to be volatility. The returns are going to be no different. And you can't just simply latch on to one specific number and say, yeah, that's our discount rate. That's what we need to be. There's a range of reasonableness around any particular estimate. And part of the process is our office gets together with the investment office. We analyze the expectations, the CMAs, the volatility around those CMAs. We generate part of the process is that they also provided the actuarial office with several thousand investment scenarios. We take those scenarios, we look at where the funding levels and contribution levels happen with all the plans, and based on all that analysis, we make our recommendation of the discount rate. So it's a long process, JJ. It's not just simply take a survey, get the expectation, and say, oh, that's what the discount rate should be.
Okay, I have a better understanding. I thank you.
All right.
Thanks, Scott. Stephen, this is for you. Would the new total portfolio approach create more volatility due to higher active management risk?
Well, thanks for the question. The answer is not necessarily. It depends. It's possible that we could take active risk, which is volatility dampening. So it could be that we're investing in diversifiers. That would also be a deviation from the reference portfolio. But we will be reporting what we expect the volatility of the portfolio to be, so you'll see that. But I have made clear that we're likely to be taking more active risk. That could either add or detract or make no difference to the volatility.
And another investment question for you. The 75-25 reference portfolio, is that 75% public equities, or does it include private equity? Also, what type of tactical changes are possible under TPA that were not possible before?
Okay, the 75% is public equities. So obviously, if we want to invest in private equity, we're going to be funding that out of the public equity primarily. In terms of what's possible, I think the most important thing is a mindset, because with a strategic asset allocation, the teams are more siloed. They sit there, they have their own asset class, they make investments for those asset classes, and they don't need to collaborate or coordinate in the same way as they will under a total portfolio approach. So each of the teams now has to think more about, well, is the investment that they're looking at competitive relative to other investments that other teams can be making? It's also possible, and we're seeing this already with the team members, that there's something that might fall between a couple of asset classes. For instance, it's possible that something fits somewhere between private equity and private debt, particularly if it has a convertible option element to it. In some cases, it might not be that clear, well, which area does it fit into? Under a total portfolio approach, the question is, does it have a place in the portfolio? If the answer is yes, we'll find a home for it. So I think it's, as I say, just to emphasize, it's really more about the mindset, and it's more about asking, does this have a place in the portfolio? And finding a home is kind of a secondary element. Because when you've got teams focusing on sort of narrow asset classes, they tend to miss some of those things that potentially cross asset classes. And also the mindset, as I mentioned, it's really, is this a good investment for the portfolio rather than does this help me fill the bucket in terms of my asset class? I
Great,
also,
thank you.
I also think where the mentality or the mindset will allow for more adaptability and more flexibility as market conditions change. But I don't expect us to, dramatically change, turnover in the portfolio or anything like that, because a lot of the areas we invest are illiquid and they require very long planning horizons, and you won't see much change there.
Great. Scott, I think this question is probably for you. If an employee submits their application for retirement prior to November 20th, 2025, with a retirement date after November 20th, 2025, which rates options are used? Will the employee or member see the change?
For basically, the new assumptions impact any retirements that occur after November 20th. So if the retirement date, is in December or next January, it'll be based on the new assumptions.
Okay, thank you.
Sure, but I would also add that, the change to the option factors are not the same as the increase to the are not the same as a change to employer contribution rates. There are two separate things, and the differences in option factors are very slight, because the way they work, it's just like I don't want to get into the details too much, but it's like taking ratios. So you have two ratios of numbers both numbers are changing, so the ratio has minimal impact. Trying to not go too far into the details in terms of the mathematics, but the impact and the changes in the option factors are not noticeable.
Okay, another one for you. Did the board confirm the discount rate for funding valuations? Oh, it disappeared. If so, what is it?
Yeah, the board confirmed the 6.8 discount rate. And they kept it, it's the same discount rate that it's been for the last 4 years.
Great, thanks, Scott. I think this question is also for you, Scott. It says the average rate increase that was just shown on the slides, does it already factor in the return of 11.6% for fiscal year 24-25?
No, it doesn't. These do not reflect that higher return. So you would keep that in mind going forward. The changes are just kind of based on an ultimate impact. So the additional higher return we got that year would be a separate impact in terms of your contribution rates.
Scott, could they use pension outlook tool to model that 11.6% return?
Yeah, now I don't want, the 11.6 was an estimated number. If you look at the November FAC item in terms of return, that number actually ended up being 12.1%. And so when you go in the pension outlook and you model that, if you want to model it, you'd want to put 12.1 in there as a percentage. And we have that number kind of defaulted to go in there. You could actually change it, but you can flip back and forth. We have instructions and notes on how to put that in there, and we actually are having it default to putting that number in there as well. So you wouldn't want the 11.6, you want actually 12.1. The reason they're different is when we announce returns in July, there's a 3-month delay in terms of private equity. That number and that adjustment gets reflected in the final numbers that get presented to the board in November. And that's why there's a slight difference in those returns. And the returns were actually higher this year. So it was an additional 0.5% return.
Thanks, Scott. I think this question would be for you, Stephen. It says, I assume the additional risk anticipated being taken is needed to meet the 6.8% discount rate. That added risk would generate an additional 60 bips in return. So absent the added risk, would the average return be 6.2 instead of the 6.8?
Look, thanks for the question, Bob. Clearly been reading the materials. What we showed was what we thought the return would be from the reference portfolio, just a simple equity and bond portfolio. And I think for the 70-30, we had it at 6.2. And I think for the 75-25, we might have had 6.3. But you're right that we needed to take some active risk to generate the return. And of course, our actual portfolio currently isn't just listed equities and treasuries. It has a whole range of asset classes. So this was I guess, an alternative way of building up to the total expected return. So it's the reference portfolio return plus what we think we're going to get from taking active risk. And as you noted, Bob, we're expecting to generate an additional 60 basis points by taking around 300 basis points of active risk. So yes, that was required to get to the return we wanted.
Okay, I think this question is also for you, Stephen. It said, how will the change influence contributions? Oh, wait, no, maybe wrong question. If the 3% allocated to other is expected to bring 60% higher returns, it would have minimal impact to the overall return. Why bother?
If I could find an extra 60% return relative to something else on 3%, I'll definitely take it. If you're thinking about, let's say, 3% of the portfolio, that's 18 billion. If you're getting a 60% higher return, it amounts to a lot of dollars and it helps fund those pensions. So we've always got to be searching for the best opportunities. Yeah, to me it matters. We should always be trying to find the best investments. But you are right that there will be some things that are just too small that don't scale or don't have enough impact on the portfolio.
Scott, I'm not sure if you could answer this question. It says, how will this change influence contributions from the employee and employer through payroll processing, and when?
It really doesn't change the process in terms of how those contributions are processed. What we'll do is when we issue the next annual valuation and the contribution rates, we will reflect these changes in the cost calculations, and then it'll follow the same process that it always does. So in terms of payroll processing, CalPERS will issue the reports, they'll load the rates into my CalPERS, and it'll follow the same process as you follow now. There'll be no change. There's nothing that employers need to do in addition for these new assumptions to be implemented. It will just work its way through the contribution rates that you see every year.
Great, thank you. So Stephen, we have a question that says, will there still be some sort of asset class targets with TPA, although not fixed compared to the traditional strategic asset allocation? How would the rebalance work with TPA?
First, yes, there will be asset class targets. because, of course, we want to know what portfolio we're trying to build. So what will happen is that each year, all of the various asset class heads will get together to be thinking about the opportunities they see, and will have views on, I guess, the potential investments they could be making, the expected returns, the risk, and so on. We'll all get together and think about where we want the portfolio to go. So we will have a forward-looking target portfolio. That's strategic. So you won't necessarily see what that is, because forward-looking, we don't really want to communicate to the market what we're going to do, because we could be front run. But we will be getting together and forming that view on where we want to go with the portfolio. Now, because a lot of the investments in the portfolio are liquid, we can't change them that quickly. So we'll be thinking about those things probably on a 3-year horizon. But each year we expect to have an annual target portfolio, and we will communicate that with the board. You will see where we're actually getting to. We will report the asset class allocation quarterly. So you'll see where the actual portfolio is. But for operational reasons, of course, we do want to have expected portfolio build and a target that you refer to. In terms of the rebalancing, I don't really want to talk about the frequency of that, but the reality is, the board has referred to a risk in the context of the reference portfolio, the 75-25. So we will always have that in mind in terms of the overall market risk of the portfolio, and we will want to rebalance back to that at a particular or a potential frequency. But I won't go into the details of exactly what that rebalancing might be. Again, that's probably strategic.
Thank you. So with about 3 minutes left, I think we have time for one more question, and Scott will conclude with you. It says the slides were focused on employer contribution rate impacts. What impacts are coming for employee contribution rates?
Okay, so we did have one slide on PEPR member contributions, and also, if you go back to the presentation in November, in the appendix, there's additional slides on PEPR member contribution impacts, and it has a number more details. I think there's 3 or 4 more additional slides as well in the appendix that go over the PEPR member contributions. But like on this page, if we look here, for miscellaneous plans, most members, as you can see, by looking at the member count for miscellaneous plans, aren't going to be affected by the change in assumptions. For safety plans, that's not the case. For safety plans, around 2/3 of the members should anticipate a change in employee contributions. I think if those slides have a little bit more of a breakdown in terms of what the particular ranges would be, what would the impact be, whether it be 1/4%, 0.5%, or more for the particular safety and the miscellaneous plans. But the information, I don't have it here in front of me. I just have it, these large number counts in terms of plans and members. There are a little bit more details in the presentation in November on the board, given to the board. It's you should just go to our website, go to board meetings, and during the FAC presentation, there's additional slides in the appendix, and that kind of lists a finer breakdown of anticipated changes in PEPR contributions. I also want to remind everyone these changes would take place in 27-28. So about 18 months from now, a little over 1.5 years from now.
And Scott, we can send a link to that PowerPoint presentation when we follow up and provide the slides and the post survey link to the attendees on this call today, so they're able to find that information easily. So we have about a minute left. I just want to take a moment to thank Michelle, Stephen, and Scott for their time today and providing this presentation, and for all of our stakeholders for logging on and listening to our webinar. Again, this will be recorded and posted on our YouTube page in the coming days. So thank you again and have a wonderful day. Bye-bye.